For the third and final section for our depreciation unit, we are going to look at the last two types of depreciation methods. So real quickly, if we go back up, there were three depreciation methods that we were going to be looking at. We just looked at the straight line. Now we're going to we're going to look at double declining and our units of production. So the first one with double declining. The whole purpose behind a company using double declining method is they want to be able to depreciate a whole bunch up front right now. And it's very similar to the tax method that the IRS uses called makers. An example of a when to use this would be with brand new technology. Usually if a company gets brand new stuff, everybody wants to use it as much as they can because it's the latest and the greatest. While the older stuff still might get used, but not nearly as often. So if we were in a manufacturing or like a factory and I bought a new lathe machine to cut the wood, the brand new thing that had all the bells and whistles, everybody wants to use it. It's going to be used pretty much nonstop. So if I'm using it a whole bunch the first couple years, I want to depreciate it. I want the depreciation to match that. And then after 2 more years, maybe I buy a new machine and it's even better. Well, this now 2-year-old machine is going to get used quite a bit less, so therefore I would want to depreciate it a little bit less. So when we do the double declining method, there are 3 things that we're going to look at. It's not a terribly difficult method, but it's probably the hardest of the 3, but still it's not that difficult. The first thing you want to do is we're going to look at depreciation as a percentage. And whatever the straight line rate is, we're always going to take double that. Now let me explain that, what I mean. If I have a 5-year life and I'm using, let's do 10 years. 10 years is really easy to think about. If I have a 10-year life and I've used now 1 year out of those 10, 1 over 10 would be 10%. That would be the straight line method. I'm using 10% every year. Well, if we were doing the double declining, I would say, okay, 10%, and we're going to multiply it by 2. We're going to do 20%. If it was a 5-year life, 1 over 5, that equals 20%. Double declining says multiply that 20% by 2. We're going to have 40%. And then whatever that percent is that I calculate in step 1, each year I'm going to multiply that percentage by the brand new book value. Because remember, every year the book value changes. So whatever my most recent book value is, I'm going to multiply that by the percentage that I just found in step 1. We're always therefore getting a new amount. The final thing that we do need to keep in the back of our head when we get down to the later years is the issue of salvage value. Because note here in steps 1 and 2, nowhere did I mention anything about salvage value. When we start our brand new first year depreciation, my book value is simply the cost of my asset because I haven't depreciated anything. So instead of worrying about the salvage value up front, I'm going to think about it for later. Meaning that whenever I'm going through, my book value at the end of that year cannot go below the salvage value. When we get close, then we're going to have to start looking at, and maybe we won't be able to use the full 40% if we were doing the 5-year life. We might have to tweak it down so my final book value stays right at or always above the salvage value. So I think this will make a little more sense if we throw back to our example. Remember back to our first video, we had the car example, and we bought it for $19,000, $4,000 salvage value. What I want you to do again is show now how double declining is different than straight line. The only difference is we're going to assume for ease purposes, that we bought the vehicle in January instead of July. Remember back at the straight line, I threw in a little curve that we bought it in July. This year, for this example, we're going to assume it's January. So here's how I would think you'd want to set it up. Okay, our first step, this was a 5-year life. We still had the 5-year life. So 1 out of 5 years is 20% using straight line. Well, double that is 40%. That's what the double declining method is wanting us to use. So now we take 40% times whatever the most recent book value is. 40% times the most recent book value, and always making sure that our book value stays above or equal to our salvage value. Let me put this into hopefully a little chart that I hope will make sense for you. Okay. Now, so January 2017, I got the vehicle, put it on my books for $19,000. That is its book value, $19,000. Yeah, I haven't depreciated anything. When I get to year 1, or the end of 2017, I'm simply going to take that most recent book value, $19,000, multiply it by 40%, because that's what the double declining method says to use, and that's going to tell me my most recent depreciation expense. Oops. I don't have any accumulated depreciation yet, so therefore that is also what my accumulated depreciation is. Now for the book value, remember the original cost was $19,000. 19 minus my up-to-date accumulated depreciation leaves me with $11,400 book value. Now when we get to year 2, this 11,400 is my brand new book value number. So that's what I'm going to want to use as my starting point. 11,400 times 40%. If you do the calculation, you get 4,560. 4,560 plus what I already had in my accumulated depreciation T account does equal 12,160. 19,000, my original cost, minus my brand new accumulated depreciation, gives me a book value of 6,840. Now, at this point, I'd like you to pause the video, catch up, and then I want you to go down and try to finish out the next 2 years. And I'm just going to remind you that year 4 will be a little different. Because year 4, we can't use the full 40% because that would cause us to go below the $4,000 book value or salvage value. So pause it, and I will go through the answers here in just a couple seconds. Okay, for 2019, hopefully you've got this worked out through. I'm going to start with 6,840, times that by 40%. And at this point, I know I'm starting to get a little close to that 4,000 salvage value. I still have 2,840 left that I can depreciate. I was real close with the number I had for year 19. But closest is fine. I can use all of it, 2,736. Add in 2,736 to my most recent accumulated depreciation. My brand new accumulated depreciation is the 14,896. 14,896 minus the cost of my asset leaves me with only a book value of 4,104. Now we'll want to keep in mind at this point my salvage value is 4,000, so I only have $104 left that I can possibly depreciate. So therefore, if I took 4,104 and times it by 40%, it's going to be way over $104. So I need to stop at the 104. Brings me accumulated depreciation up to 15,000 and a book value of 4,000. Then in year 21, for that 5th year, I don't depreciate anything. So that's what it would look like for double declining method. Now let's jump over to number 33, part 3, and let's do a practice. So in this case, we need to first off decide how much is my new vehicle going to be worth. And then, if we have a useful life of 8 years and a salvage value of $4,400, how am I going to depreciate? And notice here how I want you to give the answer. I want you to give it to me, tell me the depreciation expense for year 1, and then what's my book value at the end of year 1. And then I want you to go ahead and just tell me what year 4 is, and what my book value is at the end of year 4. But you'll find that you cannot just jump to year 4 like you might be able to a straight line. You're going to actually have to do this chart and do years 2 and 3 to get to the year 4 answer. Okay, so I want you to try it. Pause the video at this point, and I will go through the answers in just a few seconds. All right, let's look at the answers here for number 33. Number 3. You should have had, let's look at the example here. We didn't want to list our vehicle at $15,000 because I got a rebate. That's just like getting a discount if I pay on time. Well, in this case, instead of getting a purchase discount and taking off of our vehicle, I got a rebate, which is in a sense the same thing. So therefore, my vehicle never cost me $15,000. I don't want my vehicle on my books for $15,000. I want my vehicle on my books for less than $1,500, so only $13,500. So that's going to be my starting amount here for my day 1 book value, $13,500. If you need to adjust your numbers based on that, you want to pause at this time and do so. Now, with an 8-year life, in your calculator, simply type in 1 divided by 8, and then multiply that by 2. When you do that, you're going to get 25%. So therefore, we're going to take 25% times my most recent book value, and when you do that calculation, you'll get $3,375. Our then total accumulated depreciation would also be $3,375. So to get my updated book value, take the $13,500 minus my brand new accumulated depreciation, and I'm left with $10,125. Year 2, we do the same thing. Take my most recent book value, times it by 25%. My depreciation, you'll always find in double declining, continually goes down each year. That's because my book value continually goes down. So 10,125 times 25% gives me the 2,531. Add in the 2,531 plus my most recent accumulated depreciation balance. I'm left with 5,906. Finally, take the 13,500, my cost, minus my brand new accumulated depreciation balance. I have a brand new book value of $75.94. Now, usually after I get about the 2nd or 3rd year, I need to start looking at my book value and making sure that I haven't gone below the salvage value. In our case, if we look back, the salvage value is $4,400. So I'm still okay, but I need to keep that in the back of my mind as I go forward. Year 3, $75.94 times 25% gives me $1,899. When I add in the $1,899 plus my most recent accumulated depreciation balance, I got $78.05. 13,500 minus the 78.05. I'm starting to get real close now to my $4,400 book value. So when I get down here to year 4, if I take $56.95 times 25%, that's going to take me over what I have left. I only have $1,295 left. If I do that calculation, it's going to be over that. So I have to stop then at $12.95. Gives me a new accumulated depreciation of $9,100, my book value of $4,400. So my answers, if I were to do this going back up to my original answer for year 1, depreciation expense for year 4. Notice I asked for the expense, not the accumulated depreciation. Book value for year 1 and book value after year 4. So that's double declining method. Our last method is actually a pretty easy method. It is the units of production, and it won't take us more than about 5 minutes or so to talk through this one. Units of production does not worry about years. It worries about how much you're actually going to use your asset in terms of production out of it. A vehicle is a very good example to use for units of production because you can easily tell how much you're using your vehicle based on the mileage. So the only things you need to know, you don't need to know the years, but management's going to have to estimate how much are we going to use our asset. If we're talking about a vehicle, how many miles are we going to be using it? So maybe it was 100,000 miles. And then the only other thing I have to know is I got to compare that to what I actually use on a year-to-year basis. If I use 15,000 miles out of 100 total, that's 15%. And that's kind of how this is going to be laid out. It's very easy, the units of production. You're going to see that step 1 is actually the same as straight line. We take our actual recorded costs on our books minus the salvage value. That's exactly what straight line did. It gives us our depreciation cost to starting value. And then the nice thing about this one, whatever our answer is, it automatically jumps down to the next step. So I'm going to take whatever that depreciable cost was, and at that point I'm going to divide it over the total estimated units that I think I'm going to use. So let's just make it easy and say I had a $10,000 car, and I think I'm going to use it for 100,000 miles. If I do the simple division there, 10,000 divided by 100,000, that's 10 cents per unit, or in this case, 10 cents per mile. When I'm doing the units of production, as long as nothing changes like with straight line, steps 1 and 2 will always be the same. We don't need to redo them. The only thing that I have to redo on a year-to-year basis is simply step 3. I need to take that 10 cents per mile and then actually multiply it by how much I used the car. So 10 cents per mile, and if I used it 15,000 miles, that would be a depreciation expense of $1,500. Okay, so let's do the practice. Going back to my vehicle example again, the car at $19,000, salvage value of $4,000. The only new things now is I expect to use my car 150,000 miles in total, and then I give you the first 2 years of actual mileage. And what I want you to be able to tell me then is what is the depreciation expense for the first 2 years of this vehicle's life. Okay, so let's do our 3 steps. Step 1, cost minus salvage value, exact same as the straight line. That number, 15,000, divided by my total amount of miles that I expect to use, 150,000. So it come out nice and neat again, 10 cents a mile. And then in year 1, if I drove 35,000 miles at 10 cents a mile, I have a depreciation expense of $3,500. Leaving me now a book value, cost, minus my accumulated depreciation of $15,500. For year 2, I wouldn't have even had to redo these steps 1 and 2. I could easily have just taken those out, and in fact I will, just to show you. Step 3, that's the only thing I need to do. Take the 10 cents a mile times the 40,000 miles now for year 2, and that's how I come up with the $4,000 depreciation expense. My updated book value, total cost, minus my brand new accumulated depreciation balance, which was the $3,500 from last year plus the $4,000 this year, gives me $7,500. So a new book value of $11,500. All right, let's do one more practice, and on this one I want you to try it on your own. I'll pause the video. So let's go to back to the final one on number 33. We're buying a vehicle in July, year 1. I give you the total cost of this vehicle, and then how much it cost us to install and test the machine. I tell you that this machine expects to make 50,000 tires in its life. Salvage value of 14,000, and then how many I expect to collect, or how many I expect to make over the next 2 years. You'll find that the date here has no relevance. It doesn't matter when I bought it. What matters is how many am I making when I bought it. So I want you to tell me the depreciation expense and the updated book value for each of the 2 years. Make sure you have the starting value right, and then go through your steps 1, 2, and 3. Pause the video at this point, and in just a few seconds we'll go through the answer. Okay, so the answer here for the last one, my actual cost on my books should be $164,000. I need to add in the $7,000 to the original cost of $157,000. Remember, any cost that gets the item ready to use. So step 1 then says, okay, take the cost of your asset, $164,000, and subtract out your salvage value, which was $14,000. So that leaves me with a depreciable base of $150,000. Step 2, take the $150,000 divided by how many items we plan on making in total. That tells me for every tire I make, I'm going to be depreciating $3. Therefore, my final step, if I make 7,500 tires and I'm depreciating $3 a tire, I'm going to depreciate my first year an expense of $22,500. So I'm going to do my actual calculations for year 2 and then show the final answers. Actually, we'll just put it up here now. I went ahead and did the journal entry. You didn't have to. I didn't ask for it. What I asked for is what is the depreciation expense, and here it is. And then getting the book value, the cost of my actual asset, the $164,000. Remember, I don't do anything with this $150,000. It's only there for calculation purposes. So again, I go back to the cost of the asset, $164,000, subtract out my brand new accumulated depreciation amount, and I've got a book value of $141,500. Now, if you need some time, go ahead and pause and try to see if year 2 you can get that correct in your answers. For year 2, remember, I only have to do step 3. That's the only thing that's different. Step 1 and 2 are exactly the same. So step 3 is if I have $3 a tire depreciation and I make 12,500 tires, my depreciation expense is $37,500. You can do the journal entry. I just did it to show us. You didn't have to. I didn't ask for it. So therefore, my book value after year 2, I take my opening cost, $164,000, minus my brand new up-to-date accumulated depreciation with the last 2 years added up, leaves me with a book value of $104,000. that will conclude our lecture here for part 3. The final piece of the lecture will be some Wiley Plus help that we will do.